A 409A valuation is a specialized type of valuation that typically is associated with the issuance of stock options, profits, interests, restricted stock units, and so forth. Such securities are typically intended to be deferred compensation that incentivizes key employees and other stakeholders in the company to participate in that company over the long term. The name 409A itself refers to Section 409A of the Internal Revenue Code, governing the taxation of such instruments. In effect, Section 409A refers to a test to determine whether or not the stock options or other compensation qualifies as deferred compensation from a tax perspective or current compensation from a tax perspective. In effect, the test refers to the following. If the fair market value of the underlying shares is greater than the strike or the exercise price, and therefore from a theoretical standpoint, the options could be exercised profitably by the recipient, then the options are considered current income from a tax perspective, just as if the recipients had received cash, meaning that there would be a full tax liability on those options for a non-cash benefit. As you might imagine, the tax ramifications are so disastrous for the recipients that if they're smart, they'll simply decline to receive those options to begin with. On the other hand, if the strike or exercise price is above the fair market value of the underlying shares, then the options qualify as deferred compensation, which typically means that a tax event will only take place when the options are exercised, which typically occurs upon a liquidity event of the company, which means either a sale to a third party or in rare cases an initial public offering. A 409A valuation is typically carried out in 3 phases. First is to determine the overall value of the company. This is typically accomplished by applying a discounted cash flow model or some market-based methodology. In some cases, if a transaction has taken place involving the company's stock, such as a capital raise, in a time period that's recent relative to the issuance of the stock options, then the price of the company itself in that transaction might be used. Phase 2 involves the allocation of value among the various share classes. It is often the case, particularly with technology companies that have raised outside capital, that they have a complex capital structure involving preferred stock, convertible debt, anti-dilution rights, liquidation preferences, preferred dividends, conversion rights, and so forth. Each of these features must be carefully considered in the model in order to properly allocate value in order to achieve a correct common share value. Phase 3 involves the application of potential discounts, such as discounts for lack of control and/or marketability, depending on the specific facts of the valuation. In most cases, this is accomplished by using what's called the option pricing model, as discussed in the AICPA Practice Aid Guide to the Evaluation of Equity Securities issued as compensation. A sound 409A valuation is not only important from a tax compliance perspective, but also from the perspective of attracting investors and buyers. We've seen on several occasions where investors and buyers have focused on the 409A valuation as a due diligence item. And if they suspect that a 409A valuation is either not done properly or not even done at all, that it either motivates buyers or investors to lower the valuation that they're willing to pay for the company, and in rare cases, walk away from the deal entirely. If you need a 409A valuation or think you need a 409A valuation and have questions about the process, contact us to set up a free consultation.